Okay, let's get right into it. Welcome to our explainer on the U.S. taxation of multinational transactions. If you've ever found yourself wondering exactly how the IRS handles money that crosses international borders, well, you are in the perfect place. We're going to completely demystify the incredibly complex world of U.S. international tax rules, mapping it all out so it actually finally makes sense.
To really grasp why this matters, think about this number for a second. $6.58 trillion. Back in 2022, that was the staggering amount of gross receipts generated by the non-U.S. subsidiaries of U.S. multinational corporations. I mean, business is increasingly borderless, and where there's that kind of money floating around, you better believe national governments are highly motivated to figure out exactly how to tax it.
To make these abstract concepts a bit more concrete, we're going to follow a really relatable case study. Meet Daniela Lopez. She is the proud owner of the Detroit Doughnut Depot, or 3D, a highly successful local bakery in downtown Detroit. Daniela has a big dream. She wants to take her business global by expanding just across the border to Windsor, Canada. But to make that happen, she has to navigate an absolute maze of tax laws.
Here is the exact roadmap we'll follow for Daniela's journey. We'll be covering 5 escalating stages of complexity. First, the global tax nexus. Second, sourcing income and deductions. Third, the foreign tax credit. Fourth, choosing a business structure. And finally, treaties and anti-deferral rules.
Let's kick things off with Stage 1, the global tax nexus. This is really the biggest initial hurdle of any international expansion, because you have to figure out which government actually has the legal right to tax you in the first place.
National governments generally claim the right to tax based on one of two main concepts. First, you have residence-based jurisdiction. That means the country taxes your worldwide income simply because you're a citizen or a resident there. On the flip side, you have source-based jurisdiction, where they only tax the income you earn within their actual geographic boundaries. Now, what's super interesting here is that the U.S. applies a hybrid approach. It taxes its citizens and residents on their worldwide income, but it taxes non-residents only on their U.S. source income.
Now, when the U.S. does tax a non-resident, it neatly categorizes their income into 2 very distinct buckets. The first is effectively connected income, or ECI. This is your active business income, and it's taxed on a net basis, so gross income minus deductions, at standard graduated rates. The second bucket is FDAP income. Think passive income here: dividends, interest, rents. This one is taxed on a gross basis through a flat 30% withholding tax right at the source, meaning absolutely no deductions are allowed.
And that brings us to a really critical question for our bakery owner, Daniela. Let's say she hires a Canadian citizen who lives in Windsor, a guy named Stanley Cupp, to drive her delivery van into Detroit every single day. Does Stan accidentally trigger U.S. tax residency just by making that daily commute?
Well, to find out, we have to use the substantial presence test. And honestly, this brilliantly illustrates the IRS's unique brand of math. See, they don't just look at the current year. If Stan works in the U.S. for 132 days this year, he easily passes the initial threshold of being present for more than 30 days. But then the IRS adds 1/3 of his days from the prior year and 1/6 of his days from 2 years prior. By his third year of commuting 132 days, his calculated total hits 198 days. Because that exceeds 183 days, Stan inadvertently becomes a U.S. resident for tax purposes. Crazy, right? Which leads us perfectly into our second section, sourcing income and deductions. Once you know who is taxing you, you need to know exactly how the IRS determines whether the money you make is officially considered U.S. or foreign sourced.
The geographic rules for sourcing different types of gross income can actually be pretty surprising. For instance, interest is sourced based on the residence of the borrower, whereas dividends look at the paying corporation's residence. If you're talking about compensation, it is strictly about where the physical services are performed. Rents and royalties? That depends on where the property or intangible is actually used. And if you are selling purchased inventory, it's all about where the legal title officially passes to the buyer.
Let's see how this all plays out for Stan, our Canadian delivery driver. The IRS sources his compensation strictly on a time basis. So if he spends 12.5% of his total working hours physically driving inside the U.S., then exactly 12.5% of his salary is U.S. source income. Now, there is a commercial traveler exception in the U.S. tax code, but because Stan is in the U.S. for more than 90 days, he completely fails it. His U.S. source wages are subject to U.S. tax.
All right, moving into our third section, the foreign tax credit. If Daniela successfully opens her Canadian branch, she's going to face a massive problem. Canada will tax her branch profits because they were earned there, and the U.S. will tax her worldwide income because she's a U.S. resident.
So how on earth does she avoid paying taxes to two different governments on the exact same donut sales?
The answer is the foreign tax credit, and the absolutely crucial point here is the limitation formula. The U.S. essentially says, look, we will give you a credit for the taxes you paid to Canada, but only up to the amount of U.S. tax you would have paid on that specific foreign income. By taking the ratio of foreign taxable income to total taxable income and then multiplying it by her pre-credit U.S. tax, Daniela finds her maximum allowable credit. It's basically a residual tax approach that limits her credits to the U.S. corporate tax rate of 21%.
But wait, the IRS doesn't just let you lump all your global income together. To keep things incredibly strict, they force taxpayers to segregate their foreign source income into 4 distinct baskets: passive income, general income, foreign branch income, and GILTI. Why? Mostly to prevent a multinational company from blending highly taxed business income in one country with low-tax passive investment income in a tax haven, just to artificially maximize their tax credits.
As Daniela's Windsor operation really starts to grow, she enters our 4th section, choosing a business structure. She needs to pick the smartest legal vehicle for her cross-border enterprise.
If you ever get a peek behind the curtain at how tax professionals visually map out multinational structures, you'll generally see a few standard symbols. They use a rectangle for a corporation, an oval with dashed lines for a disregarded branch, and a triangle for a hybrid entity. The shape Daniela chooses literally dictates exactly when the U.S. taxes her foreign profits.
One really fascinating option for Daniela is to create a hybrid entity. And she can do this by simply checking a box on IRS Form 8832. For Canadian legal purposes, it's treated like a corporation, which grants her limited liability protection. But for U.S. tax purposes, it's treated as a flow-through entity, sort of like a branch. The pros here? Any early foreign losses are immediately deductible on her U.S. return, and foreign taxes flow straight through for a direct credit. The cons? Those profits are subject to immediate U.S. taxation, and she might actually lose out on certain favorable treaty benefits, like reduced withholding taxes.
Let's move to our final section, treaties and anti-deferral rules. This is where we look at the high-level strategies and the very strict IRS guardrails set up for sophisticated global operations.
Tax treaties are essentially bilateral agreements designed to encourage cross-border trade. Under the U.S.-Canada Treaty, there's a crucial concept known as a permanent establishment. It generally means a fixed place of business. What this means for Daniela is that if she just bakes donuts in Detroit and ships them in a van to grocery stores in Windsor, Canada generally won't tax her business profits. But the very moment she opens a physical storefront in Windsor, she establishes a permanent establishment, which gives Canada the right to tax that branch's income.
And just to be clear, the stakes for getting these international tax structures right are truly astronomical. Take the Coca-Cola Company, for example. In a recent dispute over transfer pricing, specifically regarding how they allocated royalty payments for intellectual property between the U.S. parent company and their foreign manufacturing subsidiaries, the tax court found they were shifting way too much profit offshore. Coca-Cola's estimated potential liability for those taxes and interest, an unbelievable $12 billion. To stop companies from just funneling profits into offshore tax havens, the U.S. uses strict anti-deferral rules, the most famous of which is Subpart F. Normally, if you operate a foreign subsidiary, the U.S. defers taxing those profits until you actually bring the money back home. But if Daniela tries to park highly portable, low-taxed passive income, like offshore interest or royalties, in a shell company, Subpart F kicks right in. It forces her to pay U.S. taxes on that income immediately, treating it as a deemed dividend, even if the cash itself never left the foreign country.
However, Subpart F only applies if the foreign company is a controlled foreign corporation, or CFC. Say Daniela partners with a Canadian investor, Maurice, to open Quebec Doughnut Depot, and they each own exactly 50%. Because U.S. shareholders don't collectively own more than 50%, it is not a CFC, and Subpart F doesn't apply. But if Daniela's husband decides to buy just 2% of the stock from Maurice, the IRS attribution rules mean Daniela and her husband now collectively own 52%. Instantly, the company becomes a CFC, and all those complex anti-deferral rules snap right into effect.
So, we've tracked Daniela's journey all the way from a local bakery to navigating the global tax nexus, sourcing rules, foreign tax credits, entity structures, and treaties. But looking at the sheer complexity of this entire system, it leaves us with a pretty provocative question for the future.
As businesses become increasingly borderless and digital, can any single nation truly capture its fair share of global profits without accidentally stifling the very innovation in cross-border trade that drives our economy? Think about that the next time you buy a coffee or a donut from a brand that operates across the globe. Thanks for learning with us today.